It's a pleasure to have with us Jeroen Bos of Church House Deep Value Fund. Jeroen, welcome.
Thank you.
It's a real pleasure to have you here. You are focused on the deep value space here in the UK, and I'm very excited to learn more about that space. So before we get to that, perhaps you can tell us a bit about your background and what attracted you to be looking at this space.
I was for many years a stockbroker at Pamela Gordon in London, and was an equity salesman. But my interest very quickly, when I started there, started to focus on so-called value investing, and especially stocks that were trading at a discount to NAV. And it very much attracted me, but I didn't really know what I was looking for, because you had lots of engineering companies and textile companies that appeared to be very cheap, but really had no real earnings. And they weren't really those great bargains or great investments that they seemed to be, although they were very cheap, but it didn't really work that attractively. And this was all pre-1987. And in 1987 the crash came along, and somebody told me to read The Intelligent Investor. I'd never heard of that book, but I read it within record time and knew immediately that I had found what I'd been looking for. And once I had read that book, I really started to focus on in a much more detailed way on these value stocks, and especially what I focused on was stocks that had a very high working capital position, and they worked the best for me. And I did that for several years, and I very quickly gained a following in London where people were interested in these value stocks but couldn't really find them. The community in America and in Canada was much bigger than it ever was in the UK. There were very few people, there were less than 5 that I knew of. And I very quickly got in contact with Peter Candle in America for the Candle funds, and he and I got on like a house on fire in virtually the second telephone conversation. He then sent me his spreadsheets, what he was looking for, and I very quickly became one of his scouts in the London market and finding these things. And it worked out quite well. He then transferred some money to Pamela Gordon that I started to manage on the basis that I found them and just started to invest in them. And he has always been then with me, and he was my second investor when I started in this fund. Another person that I worked with regularly was Jim Slater, who very much looked at stocks on a similar basis. And since then that really curtailed my career as an equity salesman, because I was much more interested in finding these cheap stocks than talking about Glaxo or Shell or whatever companies to institutions, which I didn't find really that interesting. I was much more focused on finding these very cheap stocks and buying lots of them. And the first one that I had a major success with was Amstrad, where we ended up as the second largest shareholder after Alan Sugar, where we bought the stock at such a ridiculously low level, at less than the cash in the balance sheet. And we had just finished our building up our position when Alan Sugar made an approach to the company to take it private. And I was immediately investigated by the stock exchange because they thought that I had done an insider trading or whatever. But when I explained to them that this was such an obvious one to buy, that was very quickly resolved and whatever, and I've never had any trouble with them, because I run a very concentrated portfolio where usually on an annual basis I have 4 or 5 takeovers within the 15 stocks that I own. Luckily I've never been yet accused of being on the wrong side, because the stocks that I buy, it is always pretty easy to understand after the event that actually these things were dirt cheap when I started with them. It was just that the noise around them was so negative that people just couldn't see the obvious value in them, and for that reason they became completely overlooked. So I did it for many years, and in 2003 I decided that I had enough of all of this, and I really wanted to run my own fund, because one of the things was that Peter Candle got a lot of positive news from it, from his investments, but often they were, immodestly, they were my ideas, and I wanted to get more recognition for that. And that encouraged me to make that step and start this fund, Church House Deep Value, which I've run since then, on exactly the same basis.
And can we delve a little bit more into your approach, then deep value means different things to different people.
Exactly.
What does it mean to you?
I think that deep value means I always start off with the balance sheet. That is the only thing that interests me. Lots of people try to argue that a stock is deep value when it has a low PE or it has a high yield. That I don't think is really value investing, that it is something different. I really start always off with the balance sheet, and if that shows me it is cheap, then I'm immediately interested. And I've always worked on that basis. There are certain sectors that I particularly favor. I love the service sector, the financial sector. I don't really like big industrials, but companies that move bits of paper from one side of the table to the other, they are fantastic. The companies like recruitment companies are ones that I really, really like. Obviously they are very cyclical and you have to wait for the time in the market for them to appear, but when they do, they usually come up as a whole sector being very cheap. They have very nice balance sheet characteristics that I find easy to work with. It's on the way down that cash tends to build up. They are laying off people as still they're receiving cash for work done and such like. So it looks overly positive on the way down, but it also gives me a margin of safety. And by just looking what is happening in that sector, you can see where the turning points come, and obviously that is something that is very important because it is a finite game with them. If they go so deep that they burn through their cash or whatever, there's nothing left, that is when it starts to go wrong. But luckily we haven't been involved in those. And
so how do you, I'm just interested specifically in how you go about it. How do you generate the idea? Do you use screens?
What I really do is start off by reading the Financial Times every day and just read about companies that have the figures and look at who has the results and what ratios they have. And you come across companies you've not heard of and just look at them and say, this actually could be quite cheap. I just make a note of them, what I will pay for them, and just watch them on a daily basis. And not all of them will obviously come to these very extreme valuations that I will pay for them, but out of a good group, a few will. And those are the ones that I tend to pick up, and the other ones I just miss, but could come the next time they could come around. I look very much on companies that hit new lows on a 52-week basis, sectors that do very badly, because that is obviously where you will find them. And it is generally where there's bad news, where there has been a regulatory change or whatever the environment has changed and these companies get called out, that is where you find them. And that is just what I do.
And have you focused on the UK or?
At the moment I only invest in the UK, but my new fund will invest for 30% overseas.
Okay. Would you say there is, what's the reason why you focused on the UK, or what's the reason you're now looking to invest
The funny
abroad?
thing is that it is often said that finding these so-called nets is very difficult, but I find that if that is the only area that I look for in a relatively small market like the UK, if you look hard enough you will find them, and that is exactly what I do. By looking at companies that I think look attractive but are at levels that I find them too expensive, I'm already in a much better position because I'm only having to wait for the price to drop to the level that I'm willing to pay for them and make up my mind instantly to buy them. I have done the process beforehand. And by just sitting there and watching them, there are stocks that can be bought at these extreme levels, and that is all that I do. If I can't find them, then we're just waiting cash till the period comes that they are available.
Mm-hmm. And I'd like to understand a bit better, how do you exercise your judgment when you find a net? It seems sometimes when you find these net valuations, it's almost obvious to just pull the trigger and invest because it's so cheap quantitatively or on a fundamental level.
Yes.
But what are the other considerations you then start to dig in deeper? How important is the management?
Oh yes, we have in England a pretty good reporting environment of companies. For me it is very easy to establish if these companies have been capable of generating earnings in the past, if they have positive cash flow and all of that. And that to me is very important. I won't invest in a company that came to the market last year and, for example, biotech that is with a balance sheet full of cash trying to get a product to the market. I have no idea if this product will ever be a success. So I tend to avoid them. What I love is companies that are pretty simple, that have been around for a long time and just are either caught out by cyclicality or whatever, company specific, and to see if they've been capable of actually generating money, and then it becomes a judgment are they ever able to get back to the level that they previously were. The stocks that I invest in tend to have fallen by 85-90%, that is not a problem at all. And they have really gone through the ringer and people have just given up on them. And by being so strict on what I will pay for them, I tend to avoid lots of being too eager to invest in them, but really have waited for them to have shown extreme valuations.
So I'm hearing a bit, pricing discipline is very important.
It's very
to
important,
you.
yes.
So is this really how you invest? It's the key is the price at which you buy.
Yes.
And it doesn't matter how bad the business is, you could buy any
Exactly.
business if it's at the right price.
Virtually all my companies that I buy are loss making, haven't paid a dividend or whatever, but they are at levels that they are at a discount to their working capital. They have losses, but these losses are containable for the next 2 or 3 years. Management is working at the hardest to turn the company around, or if that doesn't work, then somebody else will do it for them after they've been taken over. And it's really in that environment that I try to look for stocks to buy. I'm not particularly interested if they have the most modern technology, the lowest cost producer, whatever. That is of no real interest to me. It is extreme valuation. I try to buy a pound at 60 pence or less, and that is really all that I concentrate on. And for me, the knowledge is that the company has been successful in the past. That really is it. I'm not predictor of the future. I have no idea how these industries will develop over the next few years. I just know that I buy something that has been capable of making money, and in the right circumstances, it should be able to get back to that level.
Mm-hmm. So is that how you then increase your chance of getting it right? You focus on companies that have demonstrated cash flow generation in the past.
Exactly.
Are
yes.
there any other patterns that you've found over the years with your experience, situations that increase your chance of being right? When
Yes.
it comes to these nets, there's so many of them.
Yes, there are. I think we all have to go through a learning process and have to each case is obviously is individual case, is a standalone case, and we have to work through it and get experience in what we should be looking for and what we should expect. We have many cases of these so-called value traps and issues like that, and that is really the trick, is trying to avoid those. What I like is to see a company that has huge volumes but is not making money out of it. I'd much rather have it done to management that they can do whatever needs to be done to create the margins that they can make money again, than a company where sales has just completely evaporated and have to earn those back. I don't know how much advertising or whatever it will take to get going again. I really don't feel comfortable with that at all. I like companies that are pretty basic, but the market just hates them at the time of my entry.
And are they situations then that have strong balance sheets and possibly a rough patch, but the turnaround is possible?
Yes, very, very much so. I bought in July a company that was at a discount to cash, and it was trading at 60% of its working capital. It was making marginal money, but the fact was that they had recruited some people from very good suppliers within the industry, from competitors. The management started to make much more positive noises in that something was around the corner, that actually they had a product that could go and do much better again. I try to get in contact with the company, because usually I try to get a feel of the company before I invest, but they were pretty evasive with me, and I did buy them because they were so extremely cheap. A month later they announced that they had received a bid, and that was obviously what they were working on, and didn't want me to come and talk to them, as they were precluded from doing that. So that often happens. The companies where I tend not to invest in is the obvious ones. I don't invest in banks or in insurance companies, airlines, textiles. Those are the kind of companies. Biotechs, I have no idea. Or the sector always seems to suffer. It has one morning of great returns, and then it is all gone for the next 5 years again. I like much more basic companies, retailers, that just go through patterns of trading.
Mm-hmm. And is that, so just to understand, would you buy any of these companies in those sectors at a certain price, or you just don't focus on these? There's plenty of other things.
There's plenty of others. As soon as I don't like the accounts, then I just give up, because if they try to confuse me or whatever, then there must be a good reason why they try to create a smoke screen. There are enough companies. If you look long enough and hard enough, you will always find them.
Mm-hmm. And for our viewers in the US, perhaps, can you describe a bit the space in the UK. How would you go about, other than investing in your fund, how would one go about dipping into the UK deep value space? Can you describe the market?
I think the market is far less developed than it is in America. It is the community is much smaller here in the UK. There tend to be value funds, but because of their size, they really are running immediately into size problems. In that with 500 million, they will struggle to have a real value fund. You have to, because of the size of the market, have to be flexible on that. I, on the other hand, have a very strict criteria, and I can find plenty of them. So it equally exists as it does everywhere in the world, that you can do the same kind of investing as you do in America in any other country. In the UK, what I find attractive of it is that it is very well regulated. Companies report twice a year, the accounts are not out of date, you've got a very good shareholder support and rights. That makes me very confident to invest in these companies. Companies are very open to come and speak to shareholders, so it is very easy to establish what you're dealing with, and you're able to rely on the information that is out there.
Mm-hmm. And when you look at the types of small companies, so give us a sense of what is the average market cap, or what
I think my average market cap is something like 30 to 40 million sterling.
I see. And what's roughly the universe that
Oh, I think I did run a screen this summer, and I think that at that stage there were something like 35 stocks that are trading at net. I invest in 15 of them. I can invest in up to 30 of them if I want to, but I try to make meaningful investments in it, because what happens with these extreme valuations, if you do get them right, the stocks tend not to rise by 20 or 25%, but they tend to go by 2 or 300%, and that is really what I try to look for.
Mm-hmm.
You obviously get stocks that don't do that, and you get them wrong, but as long as the majority of them work out well, then I can take the bad ones as well.
And when we look at your portfolio as it is now, can you give us a feel for the types of companies that are in there? Are these companies that are exposed to the UK consumer, or are there little companies that actually generate revenues from all over the world?
I have a wide scale of companies that I invest in, because I'm not really interested in any particular sector that I have any kind of limits of what I can do. I can invest in any company. There are, just as I mentioned earlier, certain sectors that are of no interest to me, and experience has taught me that values that may seem to be there tend to evaporate quicker than I can sell the stock. So experience has taught me not to get involved with them. But otherwise, the scale of companies is very wide. I have retailers, house builders, property company, and service companies. Really, it is very widespread. Lots of them have some international sales or whatever, but they tend to be very much UK focused companies.
Mm-hmm. And can you give us an example of one such company that exemplifies your approach? How did you find it, and what was the investment case for it?
I can give you a few. One that I've been written up about is French Connection, that I've had now for quite a while. I bought that stock when it was trading at 37 pence. It was then had a working capital position of something like 57 pence, with an NAV of 72. It had all cash and all of that. The company had gone through a bad time, which was really self-inflicted, that overexpanded in Asia, particularly in Japan, and weren't making much money in America. The owner of the company, he is the biggest shareholder in it. He had gone through a very expensive divorce case, and had spent most of his capital on that. And his last big capital holding was his shareholding in French Connection. He was getting up to the age where he would be thinking of retirement, and I was convinced, having spoken to management, that was the one thing that he wanted to do. I thought at 37 pence that there was very little risk in this company, which had been very profitable over years. I knew that the retail environment was difficult, but this was very much a case of self-help. We bought the stock, and last year we sold part of it at 120, so it had traveled nicely since we bought it. It has now trickled down that we bought it back at 33% of the price that we sold it at. And that is one of those examples that I work with. Another one is Tenfield, which is going through a very exciting time, where new announcements are awaited on a daily basis virtually. We bought that stock.
Just for our viewers, can you describe Tenfield?
Yes, Tenfield is a very interesting company. It is a mini conglomerate. It is a business that is well known for its electric vehicle manufacture, that they actually are sold now to an American company, Smith Electric US, and that company is expected to do an IPO now in the next few months. There's a lot of excitement there because they're the oldest and most successful electric vehicle manufacturers, and they build delivery vans mainly for people like Frito-Lay, UPS, or whatever, companies that need to do short-term or short-distance deliveries on a daily basis, and there it works brilliantly. That company is expected to come to the market in the next few months. But then the Tenfield, the original business that they have, is making manned working platforms. These are used for in the shipbuilding industry, property, and wherever construction is happening. That is a business that has gone through a very, very bad time with the collapse of construction around the world. But that is coming back in a very, very strong way, mainly because of all these rental companies, which are the biggest user of these platforms, are reordering, and that is after a few years hiatus, that is coming back very strongly. But also the fact that all these health and safety regulations around the world are much keener on people working on these kind of platforms than standing on ladders where they tend to fall off. And that is a business that is very cyclical, but coming back very strongly. Tenfield has raised some money for working capital because they got so many orders on their order book that they couldn't really finance it internally. That company has now gone, we bought it at a price of 27 pence, it is now trading at 58. I think it is worth at least over 85 to a pound. So that is the kind of companies that I tend to look at.
And how much of that intrinsic value estimate is the US electric vehicle?
That is always the beauty. The beauty for me is to identify where the value is. I can see that on the balance sheet, but what I love to see is when I got a position in these companies that other people are starting to get excited about it and they start talking about earnings, because then these companies can travel for a long way, because then I can forget about whatever value I have. I only have to look at what kind of PE people think that this thing should be trading on, and that is really when they start traveling.
Mm-hmm. Now we talked about quite a few successes. As you mentioned, that not everything goes well. Can you share with us something that didn't quite work out in the past and perhaps a lesson you learned from it?
Yes, you always have ones that don't work out, but the thing is, what I would like to emphasize is you buy bits of real companies. I'm not operating in a futures market where I have a finite time period. I can sit on these things for very, very long periods of time, and that doesn't necessarily mean to say that will make them go right, but I can give myself a lot of time for them to come right. And I have had, in all the time that I've done, I think I've had 3 companies that went completely wrong on me. One of them was Alexon, which was a retailer in the UK, which undoubtedly you will agree is very disappointing to see that going belly up, but that is unfortunately what happened there. The risk, if that is the way that you want to approach it with this type of investing, is that you start off with a company that has a very strong balance sheet, but if it makes losses or whatever, that obviously that balance sheet is eroding, your marginal safety is under pressure. You buy yourself a certain time period in order for management to turn that company around or for somebody else to step in there. If that doesn't happen, then obviously you have a problem. I tend to buy usually fairly big stakes in these very small companies. That is where I have to be careful that I have an exit for it, and that is something you can get caught out.
Mm-hmm. And when it comes to these types of situations, how much time do you spend worrying about what management will actually do and whether control situations, do they scare you away sometimes? Or?
No, I tend not to worry too much. The worrying I do before I buy, because I always ask myself the question, am I the only idiot in the market left who didn't see what was wrong with it and why it was obviously so cheap? That is really what I try to work on, is do I understand what the problem is that this company is facing. And once I make up my mind that I understand what it is, then I'm happy to buy it. And if the price wants to go lower, I'll buy more of it. That is not my worry. What I then do, having built up the position in the company, is obviously is watch very much what comes out from the company, is when they report and whatever. What really the thing is, I don't really look at cash flows and all of that, what they're going to do with the dividend. I just want to see if they start to make slightly more positive noises, that the business is stabilizing, that they are working on a problem, and that they can see that there is light at the end of the tunnel, and that they start picking up again.
You talked a lot about the importance of the balance sheet.
Yeah.
Can you share with us any insights you may have gleaned from looking at balance sheets of small UK companies? Again, perhaps for viewers who may not be familiar with the UK market, is there anything quirky in these balance sheets, or anything that one should particularly be looking out for? I'm thinking of how these companies may account for potential pension liabilities.
The way that I look at balance sheets is that I disregard the fixed assets. So I don't look at the intangibles or whatever, because I find those very dubious. They tend to be going up when things are going well, and down when things are not going so well. So they're of no use really at all. I really look at the working capital. What is the working capital made of? Is the working capital made of completely of stocks and dubious debtors? That to me is not a good sign at all. I just want to have a nice spread of it, where cash maybe is 40% of total current assets, and debt, or the debtors is part of that compared to what the turnover of the business is, and where the stock holding is pretty low compared to their total sales, so that I'm not caught out with something that is in the balance sheet worth whatever, but the reality is nowhere near it. And that is really what I look for. What is a sensible ratio? How does that look compared to the rest of the business? And see how that works out. Are there very big jumps within them from reporting periods and whatever? Because I don't like to see that at all.
And on the liability side, you mentioned a few retailers. How worried are you about leases when you invest in these businesses?
Yes, that's a very good question, because that was one question that everybody said, is that French Connection, for example, was in a very vulnerable position, because French Connection, if you took all the leases on in 1 year, then the company was as bankrupt as anything else. That really was a no-go situation in that sense. But what was the interesting bit about French Connection is that they always have the premium sites wherever they are. And even though we have just come through a very bad recession and an ongoing recession in the retail sector, their stores always attract premiums on their leases. And that gave me the confidence that there was some value in it, i.e. that it wouldn't come back to hit them in one go. They may have problem sites, but that was something that they could deal with. But that is obviously a very important point to remember, investing in the retailer, what their estate looks like.
And generally in the UK, these leases, do they run for many years?
That depends on who you're dealing with. We have an investment in a company called Mallet, which is the premier antiques dealer in the UK. They have 2 premises, one in the UK, one in New York, with the C and Davis Street in Mayfair. That is a fantastic building that they just moved in. Every retailer is different, and you have to go through all the little bits in the balance sheet to understand, because all these deals are different, and obviously these liabilities work out differently.
And perhaps we can move on to, you mentioned you're raising a fund to invest outside of the UK as well. Are you excited about any particular geography, or how would you go about applying your approach?
I read that book that was written about Peter Kendall, in that there's always something to do. And in one of the latter chapters they wrote about that Peter would every year make one big trip, and that was always to the country that had the worst performing stock market. And I thought that is obviously the most obvious thing, because that is where the bargains are. That is what you have to do. Wherever there is bad news, that is where you should be fishing, in whatever market it may be. And I will do Western Europe and North America, because I feel confident that I can get involved there, because we have a similar structure. I don't feel confident in going through countries that are too far from my comfort zone, because the legal system may work out differently to what I would expect it to do.
So it's still sticking to
Very
Western
much so.
Europe, developed markets,
Exactly.
of Western Europe
Yes.
and the US.
And it is really that I have the capacity to do it in. It will only be 30%. The main focus will continue to be in the UK, but obviously there are in markets there are opportunities, and I just want to be in a position that I can capitalize on those.
You mentioned Peter Kandel a few
Yeah.
times now. I'm just curious, you worked with him for so long. Do you care to share with us any insights about how he went about his work, or anything you've learned from your association with him?
I have worked, as I said, for many years. I've known him for many years, especially when I started doing this just after the crash. And I got to know him very well, and I saw him many times each year. And the funny thing was that whenever we would meet, I always would have one or two examples, because that made the conversation kick off much quicker by saying, you know, I just found this, look how cheap it is. But what I learned from him is that you never know when you start investing in this company if this is the one that is going to make fantastic returns or no returns. And he always thought that if it was really cheap, that to continue buying it till you had so much of it that it really started to hurt, and not to give up on them.
Mm-hmm.
And that was always keep your confidence in it. Check what the company does, go and talk to them, go over your figures, and just if it still tells you the same story, stick with it and buy more.
And when it comes to putting together a portfolio of these deep value situations, you mentioned you like to invest knowing that some of them won't work out, and that seems very reasonable. So talk us a little bit about constructing a portfolio and how do you manage the risk in a portfolio?
The thing is that I run a very concentrated portfolio. I have, most of the time, I've had a maximum of 15 stocks in there. I would love to have 30 stocks, but I never really find them that they're that cheap that I end up with that number, but it is really that curtails me. I convince myself by buying stocks that are really cheap. That to me is the first really rule of giving me downside protection. That I buy a pound for 60 pence or less, that gives me plenty of confidence to do that. And obviously having a sensible spread within there. You won't see that I have 5 stocks within one sector or whatever, because I don't want to have that kind of exposure that I end up with having 50% in one sector, you know, any bad news and my performance is shot to pieces. So that is something that I'm conscious of. I try to have a reasonable spread in there. I always have a lot of cash. At the moment the cash is only 20%, but my best year when I was up something like 40%, I still had over 30% cash. I like having cash because it helps me to even out volatility, but also that I always have the firepower that if I find something, that I don't have to forcibly sell something, but I have it there ready to be deployed.
And in these times, just curious, so what do you keep your cash in? Is it
very much in cash? Not I used to have it lots in gilts and whatever, but that now is maybe not so attractive.
And it's in sterling?
It is very much in sterling, yes.
Mm-hmm.
Yeah, that is my base currency.
Mm-hmm. And how do you deal with illiquidity? Is that an issue for you?
Liquidity is an issue. You have to be aware of it. It can be a great problem on the way out, but also on the way in. When I buy these companies where they have had such a bad time in the market, where they have fallen by such an extent, it tends to be fairly difficult to pick them up. It can take me quite a while to buy the blocks of shares that I'm looking for, but it can always be done. I give myself a lot of time for it. I try not to tell other people what I do only after I bought them, but that is really, you have to expect that is the case. I think it is much better to buy something that is fundamentally cheap, and it may take me a bit of time to realize that and to get involved with it. But I always think that it is better to buy something cheap than looking for a smooth 10%. I rather have a lumpy 50%, so that is not a problem for me.
And when it comes to risk management, there are funds who also look at activism as a potential source of downside protection, in the sense that if things go wrong, they can take control of the company because it may be so small or there is
Yes,
less
but
assets.
yes, that
How-
is
how
not
does
something
that,
that is not something that I have pursued because I think that is a slightly different way of investing. It tends to be very time consuming. It tends to take up a lot of time, of course, but also a lot of capital. You may need other advisors in there to force the issues that are important to you. I rather be the investor identifying what is cheap, and hopefully that with other shareholders, of which luckily in the UK enough exist, who are pretty activists, to be in contact with them and just vote or whatever they tend to propose. That is something that creates momentum to unlock the value.
Mhm. And what would you say to people who, when they hear about a company that you're excited about, that is cheap for you on your criteria, and then you hear something like, I can see that it's cheap, but I just don't see a catalyst. What would you say to these
Yeah,
people?
exactly. It's that is a very good question. I tend to go on my own hunches and are pretty critical of the potential stocks to invest in. Few make my criteria. There are stocks that look cheap, but they may be very much in love with it. I think it is the best thing they ever come across. That is not necessarily that I will follow them in that sense.
And have the market events of the last few years since 2009 changed anything in the way you
No, it
do
is
business?
it is not at all. You have to go through this. I had a very disappointing time last year, where the fund did very well up to August last year, and then just started to peter out. I had no calamities in it, but it is very much the stocks that I invest in. They are really suffering when the market turns negative. That people say these small caps, I just want to be out of these. I have no interest in them any longer, and that is really my biggest enemy, because then I go through a period where these prices just drift every day a bit lower, and that is a process that can take a few months. But the beauty of it is, and I've had it many times now when the fund has been open, is that it takes very little to make up these losses in a very short period of time. As soon as there's a bit of confidence coming back, or that one of these companies announced that they've had takeover bids or whatever, they jump very strongly, and I can recover very quickly what I lost over a period of months.
And what do you think is the single biggest mistake that investors tend to make, or specifically in your area with these types of companies?
I think that people are always looking for the next winner. They are too eager to identify the next winner. And sometimes I identify companies and I get excited by them, but I try to suppress my excitement by just waiting and see if they want to go lower. Because I make my job easier having identified what I think it is worth, and just see how far the price wants to drop, because that is where I'm going to make the money.
Mhm.
Not being in too quick, because I may identify that it is quick on a statistical basis, but we may have just started a recession in a particular sector or whatever, and I want to give them plenty of time to see how low these stocks want to go before I want to start buying them.
Mhm.
It's
And
not be too eager.
And in terms of your patience, then what's roughly your time period to be invested? How long can you?
I've had stocks for 5 years. I have stocks for 3 months. It is. I've had a few that I bought, and within a month they announced that they were being taken over and whatever. And I obviously got out of those stocks because they were taken over. Other ones I will give much more time. As long as the balance sheet doesn't deteriorate, where my marginal safety continues to exist, I'll stick with them. Obviously, I hope that management is working on shareholders' behalf in rectifying the position, but I have endless patience then for them. And that is the beauty of having a fund, that you're not just having one stock that you're watching the whole time, but that you've got several, because if you have several, there's always something that will turn out amongst those.
Is there one company that you can share your investment case with us that you find particularly compelling now?
There's one company I can give as an example, which is extremely cheap. How the future will pan out will be interesting to see. This is a company that has been very successful in the UK, called PV Crystalox Solar, which is a company that makes solar panels. This is a company that has been very profitable because of the environment in which it operated, where the end user would get subsidies, and it was in a business that was growing very quickly. These two factors helped it tremendously. Recently, the level of subsidies has been cut in the UK, as it has in many parts of Europe, and this company has suffered as a result directly from it. It has been very successful, but now it is in a period of loss making. But the solar industry as a whole is still growing, and there are great expectations of it going further forward. This company is in a lucky position that it is in a very strong financial position. We bought this stock at 7 pence when it had been trading at over £2 for long periods of time, and is one of the lowest cost producers in Europe. Where the pain is felt is really coming from China, where there are a lot of very much subsidized companies operating, and that is a problem for the whole solar industry in the West. But the basis for buying this company is that it has an NAV of 57 pence, it has no debt, it is very liquid, and it is in a company that has just opened a new factory in Germany, which makes it the lowest cost producer in Western Europe. I bought this company because I think I know nothing about the solar industry, but I do know that there is an industry out there where people have great expectations of. Somebody will be able to catch in on this. I don't know if it is going to be PV crystalox, but what I do know is that they are the cheapest of all of them in the strongest position. As capacity is taken out of the market, they may well be a potential takeover target when it turns around. Because my thinking is that this company can last for at least 3 years in the current environment before it really starts to hurt. There may well be an opportunity for Europe and America to introduce import tariffs from China for these competitors. I think if that were the case, this could then become potentially a very interesting takeover target. So I've given myself a 3-year window, buying something that is at a fraction of an NAV, starting off in a very strong position. It is going through a period of difficulty, but I think that within 3 years we could expect that this industry could yet again change and that it could become much more attractive again. I think the problem with the solar industry is that the actual internals of solar panels which they make is a very old process. There are no patents in it. What really is what drives it is, are you the lowest cost producer in it, or can you have the most efficient products within that sector? They seem to be there. They're the longest established in it, so that they have a very long history in it. It is obviously a business where people say this has great potential in North Africa and Southern Europe. This is something that doesn't, once installed, it has no moving parts, it is there for the next 25 years. It seems an obvious one in a world of ever increasing energy prices, that this industry must come to a crossover point at some stage, that actually solar industry could be an important energy provider. That is really something that I'm hoping for, that will be the case at some stage.
Mm-hmm. And just can we go a little bit more into the balance sheet? Can you
Yes.
explain then what the figures are there?
I think on a working capital position, you're talking the stock when I bought it, that was 17 pence, so I bought it at less than half of its working capital position. Unfortunately, the company is making losses at the moment, which I'm aware of, but starting from that position, you know, if I start off at 17 pence when I paid 7 pence, next year it will be 14 pence, then maybe it comes down to 10. I just hope that we at some stage, before the patient dies, that we actually have found a level where it can operate profitably again, and that we can trade away from the price where it is trading at the moment.
Mm-hmm. And do you penalize, when you look at the balance sheet, do you look at the components of the inventory and penalize?
Yes, you always have to take, you know, a haircut on these things and say, you know, what is realistic on it and whatever. I went to see the management here in England and had a long conversation with them, trying to get some comfort of how they saw the world and what their expectations are. They are as interested as I am. They are involved at much higher levels, share price wise, where they have built up their stakes. I don't know what the outcome is, but I feel comfortable getting involved at those kind of valuations.
And when you now discovered this company in the UK, there may be others in Europe that also may have gotten hit
Yes,
for the same
exactly,
reason.
yes.
Do you look then, is that how you
I
generate
do that,
ideas? Or you-
no, I don't really do that in Europe as yet. I do it more in the UK because I always want to know if I find a company in a particular sector, if they have the only ones that show those characteristics and nobody else has that in their balance sheet, because then I know that either I'm being lied to or the management doesn't really understand how the sector works. So I always want to have something that I can compare to and see that there is something that I should recognize there, then it is not some made up case. Yeah, you always have to be careful of that.
For people who are just starting out in investing and are looking at deep value type of investments, do you, based on your experience and knowledge, do you have any advice to people that are starting out looking at these companies? Are there any books that you found
Yes, very, very much
helpful?
so. I think the best book that anybody can read is The Intelligent Investor, and understand what is being said there. It is a non-technical book, and it is really, really very, very clever, and give it time to understand. And then I think once you've read it and understand it, is then start investing on that basis. But start in a small way, because it really makes no difference if you start off in a big way or a small way. The losses still will come, or the profits. But just for you to get a feel for it and to feel confident with it, because you and I may decide that this stock is very cheap, but if the rest of the market still disagrees with us, it will go lower. And you must get used to that experience of stocks that just want to go lower for no particular reason, but you have to learn just to stay with them and see how you cope with that.
Great. Well, on that note, Jeroen, thank you so much for your time.